Good morning, everyone. Thank you for joining and very warm welcome to all of you. So our topic for this session is the I thought PMS universe. So in this session, we'll talk, or let's say, take you through our philosophy, unique strategies, and how we identify opportunity in today's markets. So and I thought our aim has always been simple yet powerful to help investors achieve their long-term financial goals with thoughtful, research-driven strategies and helping the investor unlock their true savings potential. So in this session, we'll walk you through how our different PMS offerings like Solitaire, Spear, TrueBlue, Vriddhi, and even Neo are designed to suit your investment needs and why we believe this multi-strategy approach can make a real difference. So we want this to be an interactive session, so feel free to note down your queries and we'll be taking them up as we go along towards the end. And a friendly reminder, we won't be discussing on individual stocks and hence please don't post any stock specific queries in the chat box. So let's dive in and explore the I thought PMS universe. So before we dive deep into our PMS strategies, I'd like to quickly walk you through our journey. At I thought our mission has always been to create a structured, goal-oriented investment experience for our clients. We started in 2011 with the mission of providing unbiased financial advice. By 2016, we expanded to SEBI-registered investment advisory and financial planning, helping clients align their investments with their life goals. In 2019, we launched our first PMS strategy, which is a flagship portfolio strategy called as Solitaire, which focused on quality and consistency in equity investing. As our clients' need evolved, so did our strategies. In 2021 was a significant year for us. We introduced two new PMS strategies, TrueBlue and Vriddhi. And let's say in the same year, we expanded our portfolio with a new launch of PMS Peer, that is a multi-asset strategy. So continuing our pace of growth, we launched a NIO, that is NRI Investment Opportunities Fund called as NEO also in 2022. So this reflects our focus on developing progressive and relevant investment solution for our investors' requirements and needs. And this continuous commitment to evolve along with the needs of our clients and emerging trends in the investment management is actually what we are focusing on. So now that you have seen our, let's say, journey, this is a snapshot of all the portfolios that we are running. So Solitaire, it's a pure multi-cap strategy where we invest across large, mid, and small cap companies. We'll deep dive and talk more about in the upcoming slides. TrueBlue, it's a pure large cap and blue chip portfolio strategy, whereas in Vriddhi is a small and micro cap strategy, and Spear and Neo are a dynamic multi-asset strategy. So before starting with each of the individual products, let's talk about our I thought investment philosophy because this is the main thing that drives every decision that we make at I thought PMS. First, we have a long-term focus. We don't get swayed by short-term noise or market facts. Our goal is to compound wealth over years, not months. Hence, we don't do anything short-term trades or let's say IPOs, NFOs, and we don't participate in swing or momentum trading. It's investing in high conviction businesses for long-term focus. Second, we have a non-consensus investing. This means we don't just follow the herd mentality. We seek opportunities where the market hasn't fully discovered the value yet and where capital can patiently thrive for long term. Our investment decisions start with deep research into individual companies and their fundamentals, rather than only depending on broad macro trends. This helps us uncover true value at company level, which is also called as bottom approach investing. And finally, a superior risk management framework is what we focus on because this underpins everything we do. Protecting our clients' capital is a paramount, and we employ rigorous risk control framework to achieve what we shall further explore in our upcoming slides. So this philosophy is what gives our investors clarity, consistency, and confidence in their investments with I thought PMS. So if I ask what makes a great investment, if you think of an example, you can think of like building a house. You need a strong foundation before you add any layers on top. So for us, that foundation starts with good corporate governance in a company where management is transparent and truly works for its shareholders and stakeholders. Next, you need great builders or contractors, right? So that's where strong leadership with proven track record comes in. Leaders who have been there, done that, and know how to grow a business sustainably for long term. Then comes choosing the right neighborhood. We want to be with the industry leaders who dominate their space and aren't easy to push around by the competitors. So we also look at high return of capital employed, ROCE. In simple terms, how well a company turns every rupee of investment into profits. It's checking if the house you build actually gives you comfort and value add for your money. And of course, no one likes a house with drowning in debt, right? So we look for low or zero leverage, companies with clean balance sheets that can handle storms without panic. So finally, even if the let's say for a house is perfect, we don't want to overpay, right? So that's why we focus on reasonable valuation. So a great business can become a great investment when you buy it at right price. So this framework ensures we don't just chase growth, we invest in business that, let's say, deliver a good sustainable returns at the right price. So moving on to, let's say, Solitaire, the FlexiCap or multi-cap portfolio, I would pass on to my colleague Nakul to proceed.
Thank you, Vinayak. So now that we have the base of how ithought works out of the way, we can dive more into deep on products. So to start off with a flagship product, Solitaire, it is a strategy where we put into effort a lot of work into creating a portfolio that people can just own without a lot of stress, without with a lot of peace of mind in place. So Solitaire as a strategy works well when people are not too keen about looking at their portfolios, can contribute money additionally to the portfolio as and when an opportunity arises. And it is a portfolio that we built after looking at portfolios over the last 30 years. So that all of that iteration has come into Solitaire, and we presented it as a product that is going to evolve as and when market evolves as well. So moving forward, what does Solitaire do? What does Solitaire do for the investor, and what does an investor need? Now, Solitaire works on a customized portfolio model. So what is the difference between a customized portfolio and a model portfolio? Let's say you give 50 lakhs to a mutual fund today. They'll go and buy 10 stocks in whatever the proportion that they have at that time. Now, for Solitaire, let's say I start 6 months ago, and let's say you start today. Your portfolios are going to look different because that is the kind of care that we take in curating individual portfolios. Because let's say I was able to buy a stock 6 months ago at a cheaper valuation. Today, if it's going to be expensive, I will not add that into your portfolio. But a mutual fund or maybe other PMSs don't do that. Secondly, investing into businesses of the future. Investing as a concept works well when people do it for the future and not looking at the back. So we are not too worried about what a company has done in the past. We are worried about how it's going to do in the future and what the growth prospects are. Thirdly, opportunistic buying. So recently, a client of mine asked me, Nakul, if I'm going to give you certain amount of money, where are you going to buy it? So we will only ask for additional capital when we see additional opportunities in specific ideas where we want to scale up. So let's say on top of the 50 lakhs, if an investor gives me 5 lakhs as an additional to invest, it won't go throughout the portfolio. It will go into 1 or 2 or 3 ideas where I feel that there is more opportunity. And lastly, we are primarily a house that wants to buy good companies at favorable valuations and hold them for as long as possible. See, while this might look very simple and this might feel very simple, but putting this into action and doing this is actually quite hard is what we've seen. And doing this is what has resulted in Solitaire doing well or us as a house doing well. So the low churn strategy not only helps you to minimize on tax payments, it also helps us to make sure that we buy good companies and we are holding them to realize their future potential. So these are the things that make Solitaire unique when compared to any mutual fund or even any PMS that is in the market. The way that we curate your portfolio, the way that we buy companies opportunistically whenever we get an opportunity, and the way that we reach out to you guys for capital is actually what has made Solitaire into a great product. It is not that we went ahead and picked multi-bagger ideas. It is just that people contributed cash and people participated in opportunities whenever they were able to, and that has led to Solitaire as a portfolio doing well. And I'm sure going forward also, we can make Solitaire into a great product. Okay. So now diving a little bit deep into how Solitaire works, let's look at how the inner workings of Solitaire is. First of all, we have a very well put together portfolio of companies, but what makes it a superior portfolio? What makes these companies better? See, ideally, a company with debt in a market turmoil is going to survive a lesser number of days than a company without debt, because there is no interest burden on a company without debt. Now, debt is a broad term. We'll classify this as debt and net debt free. Net debt free is when a company has maybe 1,000, 2,000 crores of debt. But if they have, let's say, 10,000 to 15,000 crores of cash on their books, that means the company is debt free because for benefits of operating leverage, they've taken the debt. But at any point in time, they can use this cash to pay off this debt. So no debt or net debt free will be classified as the same. And when we look at the index of BSE 500, we are almost 10% less than for companies in Solitaire that don't have debt. So that is the kind of portfolio that we are going to build to you, where these companies tend to be less volatile. These companies don't have a lot of interest expense that they need to pay. Even if they're going through one or two seasonally bad quarters, they don't have to worry a lot about making money to pay off the debt. They can stay their course and make sure that they create products and services for the future which can pay them off well in the future. So that is the benefit of having a superior balance sheet, which is a low leverage portfolio. So whatever data that you're seeing is on 30th June 2025. We're using the most latest data that is available to us. Okay, so what does the ideal Solitaire portfolio look like? See, we are not going to go for every company thinking that they are going to be a multi-bagger. Of course, we would like that to happen, but usually 99% of the time, what happens is you have few big winners. These are positions where we've taken a good sizable bet, and these positions have played out very well. These might turn out to be a multi-baggers. These can compound at a much higher rate than what we initially anticipated them to. But what is the core of the portfolio? What holds the portfolio together? What keeps the portfolio companies together? These are your multiple optimum performance companies doing somewhere between 12-15% every year. So this is what is the rock solid nature of your portfolio, where the few big winners can add maybe 1 or 2% alpha onto these performance. But these optimum performance keep the portfolio going. These are going to make sure that these are your Marutis and your Hondas of your portfolio, where these will keep the portfolios going. If you add something like a BMW or a Lexus to the portfolio, they might add that 1 or 2%. What are these losers? If fundamentals deteriorate, of course, we as a house will take a call where we are worried about corporate governance and we're worried about fundamentals as well. And even if the price of a stock is going to go up, we will sell and we will make a clean exit from these positions, because eventually these companies do not fare well, and eventually they can be a laggard on your portfolio. So we have instances where there were losers in the past that we will exited as well. So this is how an ideal Solitaire portfolio looks from a top-down or a macro perspective. Now, going forward, that is on Solitaire. So we'll talk a lot about returns and stuff on the coming slides. But now I want to take you through one more product which works as a partner to Solitaire, which is Sphere. Now, one key thing about Solitaire is Solitaire does not buy companies with debt. It is primarily concerned about holding companies without debt or debt free. Of course, there will be certain companies with debt, but this leads to the idea that we don't buy any banks or NBFCs as a part of the portfolio. Yes, you heard it right. So your big banks or your big non-banking financial companies, since the main purpose of these companies is to give out loans, is to lend. It is not that they're bad companies. It is just that they Solitaire frameworks works in a way where those companies are not part of the portfolio. So it is an advantage. It is not an advantage or a disadvantage. It is just a portfolio constraint that we want to work with. Now, moving on, we want to go for a portfolio which has a more of a family outlook to it, which forms a more of a retirement portfolio, which forms a more of a no-nonsense portfolio for people who want to kind of invest in different assets without having to worry about, when am I going to exit it? When am I going to need to rebalance? Or if I need to rebalance. So all of these things are taken care by Sphere. Sphere is a unique multi-asset product, which is a one of a kind that is created by us. It comes after 10 years of experience of what we put together on the RIA or the registered investment advisory space. Since that space got a little bit too crowded for us to handle on the regulatory front, we have transitioned it to a superior PMS product where we can deliver what we promise. So what investors usually focus on, if timing the market is going to be the right thing. Even in Solitaire, is what I'm going to pick is going to be a next multi-blagger. Complexity as sophistication. If this mutual fund will work better, or this ETF will work better, or should I go for gold? Performance and benchmarking. Of course, people are going to keep comparing each product or each fund towards the benchmark to see whatever additional fees that they are paying is able to, maybe beat the benchmark or to provide a better risk-adjusted experience. Now, let's see what Sphere helps us focus on. Next. Now, what we've seen for investors who made a lot of money or who usually outperform an index is they usually are not worried too much about the returns or what an portfolio is doing. They are concerned about making the best out of their end, which is systematically participating through SIPs, giving out a call for lump sums whenever that is available. They are also concerned about things like asset allocation, where they want to take care of asset allocation in such a way that you are worried about returns or what your money you'll make. Do not be worried about too much from which asset class or which asset gives you these returns. Simple financial products usually lead to consistent compounding over a very long time. So this can be a mutual fund, this can be a stock portfolio of 10 to 15 concentrated portions that you're holding. These don't have to be sophisticated. These can be simple, but at the same time, they do very, very well. See, the industry might want you to pick sophisticated products to make you think that you're doing something that is, out of the box, or make you think that you're doing something that is going to give you extraordinary returns. But usually, this is not what that happens. Simple financial products using consistent participation and structured asset allocation will give you all the returns that you need to become not rich, even wealthy. So where is Sphere positioned in this way? Now, why are we talking a lot about asset allocation? So all of this is before we head into Sphere as a product. If you look at the year 2020 to 2021, or maybe even 2023, you see small caps having a stellar rally, giving 30% in 2020, 2021 being almost 65%, 2023 again another 45%. Now, if you look at gold as an asset class, that's not done much in 2021. 2022, 2023, and 2024, and even 2025 financial year to date, it has been performing pretty well, and even silver has been performing very well. But if you look at your large caps as a category, they've only been middle of the pack. They have not been at the top, and they've been at the bottom, also lower end of the bottom. So what does this signal? This usually signals that each asset class or every single asset class goes through cycles. Now, our kind of thing is to make sure that we are able to kind of identify these cycles and get in on early, even if a few years we don't make any returns. At the end, we end up making good returns. So this is where the macro approach of Sphere comes in, where we want to identify themes. And once we've identified a theme, then we want to go into a micro approach where we want to pick bottom up which mutual fund to buy or which stock to buy, and so on and so forth. So a macro plus a micro approach works better. And a Sphere as a product, since it's multi-asset in nature, we can buy all sorts of things in it. So you can have equities, you can have direct stocks, which is again your equities, you can have mutual funds, you can have ETFs in the portfolio, you can have, of course, gold, silver, international. So all of these can form a diverse portfolio of assets. In addition to this, if we take a concentrated portion on an approach, that is what creates you a Sphere as a product. So your entire asset allocation is managed dynamically inside Sphere, so that you don't need to worry about being in equities, being in precious metals, or being international. Sphere takes care of all of that for you. Now that we've looked at asset allocation, let's move on to look what Sphere adds value to an investor. So first is the weather signal. Shifting to safety when the markets are heated. When at times like this, when markets are heated, taking the call into maybe buying more precious metals or even buying debt when an entire industry is not looking at debt. So these are the calls that Sphere can take to make sure that, whatever money that you made to the bull market goes into a bear market in a safer manner, so that it can be redeployed into a bear market to generate even better returns in a bull market. So these calls of safety, these calls of asset allocation is what not only preserves wealth, but gives you an opportunity to create more wealth in the future. Like I said, top down plus bottom up, the best of both worlds. So, identifying a macro theme and then going, at a micro scale into it is what Sphere really excels. And we want to go towards a high conviction investing. We are primarily focused on the equity side, on market leaders, mega caps or larger cap companies, and we take a concentrated exposure on it if required, so that we are able to generate better returns when these stocks ultimately perform. And we primarily want to stick with companies like Solitaire, which are attractively valued, but at the same time we can buy and hold on to them for a longer period of time. That is how ideas and spheres have also emerged in the past, where over the last 2-3 years, we bought a lot of precious metals. We bought a lot of financial companies like banks, which we've held on to, which is what is leading to the returns that Sphere is generating. So we picked these ideas when they were not favorite, when small and mid caps were rallying. Now, if you look at it year to date, your small cap 250 index has done close to 2-3%. Mid cap has done close to 4-5%. But your large cap is sitting, neatly close to 8-9%. So it is not that a small cap or a mid cap has to give you so much returns. No, that is not the case. It is more on which asset is valued attractively and which asset you need to invest. Now, moving on. So what does the Sphere offer when compared to multi-asset mutual funds? So first is the asset allocation limits. Multi-asset mutual funds have a constraint to maintain tax advantage. On Sphere, since each asset is taxed individually, we can go 0 to 100% in each asset class. So we can be truly flexible. So if you want to take a concentrated call, Sphere allows us that opportunity to do it. We don't have any short-term pressure on investing. All of our ideas are based at least on a 4 to 5 year horizon. And we like to buy and we like to sit on it so that even if there are 2 or 3 quarters of underperformance, we are perfectly fine as long as the fundamentals are good. We want to be contrarian. That does not mean every call that we take will be contrarian, but whatever we've taken in the past, like going into fixed assets, going into gold miners, all these are contrarian in ideas where that is what is leading to a Sphere's performance right now. But when we took it in the past, there were a lot of questions on, why are you going into these assets when small and mid caps are giving you 30-40% every year? Equity works in cycles. Every asset class works in cycles. So identifying these cycles is where the macro approach of Sphere comes in. Again, portfolio construction, this is going to be true for every single product in the ecosystem, but we work with products that are customized through your participation. So if you're going to give us some money, we'll make sure that that money goes into specific ideas and not littered throughout the portfolio. So investor exits on a mutual fund. If a big investor exits, it's gonna impact all investors. On Sphere, it is your own portfolio that we curate. So you are only worried about what we buy into you and your specific rate of returns, not what the mutual fund or other funds make as a whole. Taxation, it is on mutual funds have a redemption on the entire amount of units. Sphere, whatever asset that we exit, that will be taxed, and that's about it. If we don't exit something for a long period of time, you don't pay any tax. If we exit only one stock or 2 stocks, you'll only pay tax on that. So you have security level taxation on Sphere. Now, moving on, we have a couple more very interesting products where Solitaire, pairs well with Sphere because Solitaire does not buy banks and Sphere buys banks, and Sphere is more of a moderately conservative portfolio. Solitaire is slightly more aggressive for someone looking for a 5-6 year horizon. Solitaire works well. For someone working with a 4-5 year horizon, Sphere works well. Now we look at 2 or 3 more products where these will be curated more towards aggressive investors versus conservative investors as well. I'll pass it on to Vinayak, who will take you through these products.
So thank you, Nakul, for a broad idea about how our Solitaire and let's say Sphere portfolios are constructed. So as just to add upon the previous product as Nakul discussed, so Sphere and Neo, the philosophy, the investment management style is same. The only difference would be is Sphere would be for resident investors, and Neo, the NRI investment opportunities, which is also a multi-asset PMS, it's for NRI investors. So in this upcoming slides, I'm going to talk a bit about the True Blue portfolio. So this is a specialized PMS product focused on investing in truly high quality, large blue chip stocks in India. So True Blue is a concentrated portfolio of 20 to 25 pure large cap stocks designed to capture the India's growth story by investing in companies that are also the global champions and highly profitable. So let's talk about the USPs of True Blue. So first thing is, as I said, this is a 100% pure large cap portfolio at lower churn, lower risk and lower cost. So we don't mix and match here. It's about owning India's top companies who can weather the storms and still grow over a long period of time. The portfolio is constructed with careful attention to position sizing, quality, profitability, and valuation discipline. So this portfolio has actually demonstrated a good outperformance in volatile markets over the past year, showing low volatility of, let's say, 0.7 beta compared to a benchmark beta of 1. So it means like taking lower risk and, let's say, compounding your wealth at a conservative growth rate of return. Secondly, it's a high active share portfolio. In simple words, this isn't a, let's say, Me Too portfolio that just mimics the index or, let's say, a Nifty benchmark. We take bold, differentiated positions to create real alpha for you in the long term. So position sizing, as I said, is let's say, a critical factor. Allocations are, let's say, large enough, let's say 10 to 12% per stock to meaningfully impact large returns, or let's say, but diversify across 20 to 25 stocks to balance risk also. So this focused approach maximizes returns for high quality large caps while controlling also your portfolio risk. So third, as I mentioned, it's a low churn portfolio. We believe in buying and holding quality businesses over a long-term horizon rather than let's say, constantly trading and reacting to a market price. So this also means lower cost and lower tax outgo for you for that financial year. And lastly, the product also offers a zero fixed fee option with a performance fee only when the return let's say, exceeds 6% hurdle rate, ensuring alignment with investors' interest. So hence this comes up with a no catch-up model. So this ensures investors pay fees only for actual performance, minimizing cost during underperforming periods. So this Doobly portfolio, we'll talk about the most important terms and conditions in the upcoming slide, but I just wanted to give a heads up. So True Blue is for those who want to anchor their portfolio in the safety of India's large cap companies while still aiming for a meaningful growth in their portfolio. So in this portfolio of True Blue, if you ask me how it is suitable for, firstly, it's perfect for first-time investors. If you're stepping into, let's say, a portfolio management for first time, True Blue gives you the comfort of a large cap stability with the potential for meaningful growth. Second, it's ideal for, let's say, those investing in retirement corpus when your primary need is stability, dependence on performance with, let's say, capital preservation. So this strategy provides that. And it would be a great way to, let's say, allocate your retirement proceeds rather than the unconventional, let's say, sources like, let's say, traditional FDs and so on. So third would be, let's say, family offices love actually True Blue because it's structured to be a core steady allocation in a long-term portfolio. And finally, it works beautifully for institutional investors also who wants a disciplined large cap equity allocation with a clear rule-based execution. So in short, True Blue is for anyone who wants clarity, stability, and growth from their equity allocation with, let's say, a conservative risk capacity and, let's say, wealth preservation and appreciation as their agenda. So let's move on to Vriddhi, one of our more, let's say, exciting strategies whose process is very interesting too. So this is a pure small cap portfolio, and this strategy is distinctive because it targets emerging ideas and evolving team rather than established and popular companies that we already know. So it is designed to be more futuristic, professional, and somewhat unconventional, appealing to investors who are willing to take higher risk for their potentially significant higher growth returns over a long period of time. So let's say, for example, in this portfolio of Vriddhi, let's say, where do we fish? It would be in the mid, small, and micro cap space, an area often overlooked by big investors, but full of opportunities for meaningful growth. We look for undiscovered, under-researched, and under-owned business, essentially companies with huge potential that the market hasn't fully recognized yet. So our philosophy is simple: buy market leaders led by competent ethical management at a fair price, and we don't just chase any momentum stories or, let's say, hot trends in the market. So, and approach is very different. We follow a very private equity style due diligence, which means we go deep, understanding the business, management, and industry before we invest into a business. At the same time, we keep a sharp focus on the risk control. We'll talk more about the risk part in the upcoming slide because we already know that because small and mid cap requires very disciplined framework and, let's say, proper risk control feature to, let's say, back up for a long-term investment horizon. So most importantly, let's say, for example, a record speaks for itself. We were able to, let's say, demonstrate ability to pick winners over cycles, leveraging, let's say, good combined market experience in our team. And in short, Vritti is about spotting tomorrow's leaders today with strong due diligence and risk management at its core. So as I spoke about, let's say, under-researched and under-owned companies, let's talk about why Vritti exists and where the opportunity really lies. When we look at mid, small, and micro cap companies, there's one thing that immediately stands out. Hardly anyone is paying attention to, let's say, for example, individual companies rather than entire theme. So looking at the chart on the left, large caps have 34% institutional ownership, mid cap about 27%, and small caps barely 5%. That means fewer big players are participating, and that's what exactly where we can find value. On the right, we see another interesting picture or a point where information scarcity is actually a problem. A large cap stock typically has, let's say, 31 analysts tracking it. Mid cap around about 17, and let's say, whereas in small cap it's just two. There's a huge gap. So what does this mean for us? It's low institutional interest, low research coverage that gives us market inefficiency. But this is where we identify early, let's say, businesses which translates to outsized returns for our patient investors, which have a time horizon of 5 to 7 years plus. So in simple words, these are undiscovered gems. If we can do the, let's say, right deep work and hold this for long-term horizon, it would have a good upside potential too. But let's say, for example, I would say with a pinch of salt, this comes with a higher, let's say, volatility in your portfolio too. Let's say if you are a risk taker and let's say if you are ready to have a lock-in period of 5 to 7 years time horizon plus, in that case, Vriddhi would be a good fit for you. That is why Vriddhi focus on this space where others are not looking for. So in this case, let's say, for example, as we spoke about, let's say in mid, small or micro cap companies, we always come up with one question. Isn't this risky? So one thing is it's actually a valid concern, but we'll break it out, let's say, in Vriddhi's point of view. So poor corporate governance, it's a nature of risk. It's controllable. We simply don't touch these companies and we avoid it. Poor business, let's say quality of business. That's something like a controllable risk and we avoid it outright. We stick to scalable quality business over a long period of time. Expensive valuation, we walk away, and it's same across all the portfolios, whether it's Solitaire, Spear, True Blue, and Vriddhi. Uh, because we are also not in a hurry to deploy the capital. And as Nakul mentioned, in a mutual fund where they are in hurry to deploy, let's say 80 to 90% of capital on day one, it's in our portfolio, it's more staggered over a period of like 6 to 8 months or whenever there's an opportunity. Execution risk is something that's manageable, and this is managed with let's say proper due diligence on let's say promoters and management. Low liquidity is one risk. This is also something that is manageable, carefully navigated with well, let's say well-planned trade execution. Whether if it is building a position in a company or let's say whether it is exiting out from a company, it's going to be staggered so that we are not let's say for example fully booking out the profits and we are not overpaying for the company too. Volatility is something, it's actually not a threat. We use it as an opportunity to buy quality business at a better prices. That is what I would say. So just to talk about, let's say, what really is the Vriddhi's investment philosophy. These are just few 4 to 5 pointers that at all times our team really likes to stick to them. But this is what makes us, I would say, successful over a period of time. So we think like a business owner, we invest only in businesses we deeply understand. And let's say we back hidden champions. We pick the niche leaders with strong moats in their industries, strong balance sheet, as Nakul also mentioned in Solitaire, that we don't invest in, let's say, companies that have leverage, or let's say we try to focus with lower leverage, let's say debt books in the company. High corporate governance, we partner with only ethical, transparent promoters. Margin of safety, we stay disciplined, buying at fair prices and exiting with prudence. So the most important right that actually I'm fond about the process of how investment, let's say, or a business is bought in. Let's say before buying a business, there's a lot of things that happen on the, let's say, the journey of investing in a, let's say, company. So there happens of, let's say, reading 7 to 10 years of annual reports, going through the con call transcripts to understand where the business has been, what is the forward guidance, then we map the industry value chain and even step out for on-ground research to see what the real picture is. And no stone is left unturned, let's say unturned. Forensic accounting reveals hidden trends and red flags, while pattern recognition over a period of time help us spot consistent winners. We learn from global parallels and apply the same principles and let's say philosophies on our companies in India too. And finally, we evaluate the people behind the businesses, focus on long-term horizon beyond quarterly noise and let's say market noise, and use a disciplined checklist-driven approach to make a sound basic PS free decision investments. So in this portfolio, I would say it's not going to be, let's say, before we invest into a company, we do all this proper due diligence and let's say it would be a one-time exercise. It would be even after buying or let's say building a position in a business. This is a continuous exercise our team does to be updated about what's happening in that business. And this would be overall process about the Vriddhi portfolio. So more about the risk positioning part of, let's say, all our portfolios. So we would keep it on a chart of, let's say, conservative to aggressive. So to start with, True Blue, which is a pure blue chip portfolio, it's going to be more on a conservative side of, let's say, the risk parameter. Spear or Neo portfolio, which is a multi-asset strategy, it's going to be, let's say, a moderately aggressive portfolio or moderately, let's say, for example, in between conservative and an aggressive strategy. It's not aggressive, it's not conservative, but this is something that you can look for a consistent compounding over a long period of time. Whereas Solitaire is a moderately aggressive portfolio, which has only pure equity allocation across large, mid, and small cap. Whereas Vriddhi, as I mentioned, just it's going to be a pure, let's say, aggressive portfolio, where let's say if you have a good risk capacity of higher, let's say, risk taking, then Vriddhi is something that you can check. But this depends on, let's say, if you do have the stomach to, let's say, accept the volatility and take in, let's say, the drawdowns that happens in the small and mid cap space too. So to talk more about the upcoming slides, I'll just invite Nakul to share some insights on this.
Thank you, Vinayak. So now people are worried about how we are going to buy in a market like this as well. We do get a lot of queries from clients asking us, okay, markets are slightly more overvalued. How do you guys buy? Now, first to set context, an index hitting a high does not mean anything where when we go out and pick individual stocks. We are going to pick positions or stocks where we can find relative value and where we can scale up. If not, the rest will be kept in liquid funds or liquid ETFs inside the portfolio and used whenever we get an opportunity. So the deployment will be extremely cautious and calibrated, where we will try to make the best use of your money as possible. But one thing that comes with all of our products is we want you to think of it like your own fund. Just like you would do an SIP or kind of additional lump sums whenever market goes down, that is what a PMS is also, that is what a portfolio management service or a PMS fund is also positioned towards. So we'll do calibrated capital deployment. So whenever markets become expensive, the cash that is given us may not entirely go into ideas. It will be kept as liquid funds as well. So deploying that initial 50 lakhs of capital in a current market scenario like this probably takes somewhere between 5-6 months, maybe slightly less. So that depends on the market opportunity as well. Let's say 3 months down the line, markets fell by another 10-15%, or the ideas that we're looking at become suddenly attractive, then we can go ahead and deploy our capital. So we'll gradually scale up while sticking to basics of buying good companies at favorable valuations. If we do not get those ideas, then we'll stick to cash. We do have a long-term horizon in place. So again, this gives us a very, very good competitive edge, because we are not looking at a company from if they're going to perform in the next quarter. We are looking at if they're going to perform over 10, 15, 20, 25 quarters. So that is what our real edges, and that is what has helped us curate these portfolios for our individual investors, because not only can we take an approach where we can go gradually on the deployment front and not rush into stocks, even if there is going to be a short-term underperformance, because we are holding cash and the index is always fully invested. This helps us curate a portfolio where we'll only go for positions where we can find value. Once this is done, then whenever investors add money, that again can go to cash or go towards certain individual positions where we find more value. So we have created a kind of a deployment strategy and an execution team who is capable of doing this at an individual level as well as at the pool level. So this gives us an edge compared to other PMSs and other mutual funds which follow a model portfolio where when you give them some money, they'll go and invest it all at that day's market value or that day's NAV and be done with it. That is not an approach that we take. Next. What we don't do, because this is equally important, if not the most important. We don't go after any of these chasing these fads or investing in all new IPOs that come out. See, chasing returns is one thing, because going after hot stocks or the next big thing or the darlings of the market, this hardly works out for anyone. You see all of these mutual funds coming up with defense NFOs, new small cap funds. So all of these things usually is a momentum chasing for them to gather up AUM. See, this gives us an opportunity to look at other parts of the market where we can see a better valuation, or stay in cash and invest whenever markets correct. Investing in IPOs. See, an IPO is not necessarily a bad thing, but in the recent past, IPOs have been coming out a lot more in the market where promoters just want to take it in the market, sell off their stake and come out. So IPOs like this is what you don't want to get into, because these are trading at premium valuations when they come out, and the price only keeps jumping up. Maybe it makes sense to look at these stocks from a while back and then look to invest in them. Maybe they become a little bit more attractive. We don't invest in any momentum stocks. If a stock we hold in the portfolio goes up just because people are buying it, then we cannot do much about that. But we don't go for stocks just because they're going up. We go for stocks because they have good fundamentals and we see value in them. We don't do bad corporate governance, just like Vinayak said, is something that we completely avoid. Doesn't matter how good the price of a stock is going up or how much money it has made or how much returns it has made. Bad corporate governance is something that is a strict no-no and we'll completely avoid it. So does short-term trades. We don't do any trading, any futures and options or any kind of leverage in the portfolio. It is a pure long-only portfolio because all of these things will make sure that, first of all, there's going to be high fees. Second of all, these give way to tail events where one bad event can wipe out the entire portfolio. So these are things that we do not do and we don't involve. There are a lot more PMSs that are available in the market as well, right? So why go for ithought ecosystem, right? There should be something that we do differently that helps an investor, right? So what is that? First is a low churn. There are a lot of PMSs which have made a lot of returns, but since their churn is so high, the after-tax return for the investor is probably on par or even sometimes less than what a mutual fund does. So this is not something that we are focused on. We are primarily a low churn house. Second is scalability. I've heard from a lot of my friends and my own clients that most PMS houses just sell you a product and be done with it. That's all. That's 150 lakhs for them that you're going to pay fees on, and that's all. For us, even selling you that initial product is not something that is the driver. The driver for us is making sure that that 50 lakhs becomes $1 million or 5 crores or 6 crores so that you can create sustainable, high quality, scalable wealth for you. So repeatedly reaching out to you for updates, making sure that the relationship manager or the investment advisor who's assigned to you goes above and beyond and is not only curated about the portfolio, but also takes care of things like your insurance, your financial planning, making sure that whatever step up that needs to go, whatever money that needs to go into the portfolio towards your financial goals are all implemented. So these are all small things that add up over time, which has led to our clients making not only money from the product, but making money towards their goals as well. So it is not a product that is just sold to a client. It is a product that is tagged towards a goal, and that is going to be scaled up immensely to make you reach and probably surpass the target of your goal as well. We have a lot of people investing towards house purchases, towards retirement. So ideally, this is how you should look at investing. Not if I'm going to put it into a solitaire or a sphere. I'm going to put it into a product which is going to help me get to my goal. That is how ithought differs. We are not going to sell you a product. We are going to be a partner throughout, which is going to help you build towards your goals. Whichever product that does it, maybe through PMS, maybe through mutual funds. Again, that is a call we take on an individual investor's level. Just like what we're doing right now, we have weekly webinars that are going on where we want to talk about ideas that we are looking at in the portfolio. Last week we did something on cement. A week before that we did something on pharma. So that we want to keep the investor educated as well on what is going on. So once the investor is educated, then I think the last one automatically comes into play, right? The investor knows what is going on in the portfolio, what we as a house are looking at. So automatically, when we reach out for additional capital call on opportunities, the investor themselves contributes. So this is how the ecosystem of ithought is built, and this is how we differ from any other PMS house, which is just going to sell you a product. Now, let me pass on to Vinayak, who will take you through a concept that we've been working on for a lot of our clients as well as a lot of our leads. This is on building $1 million portfolio. This is not on products. This is not on investment thesis. This is purely on building $1 million portfolio, which is around 8.5 to 9 crores. This is a very, very interesting idea. So I'll request you guys to pay a lot more keen attention to this.
Hi, Nakul. Yes, thank you. So as Nakul just spoke about, let's say our PMS or portfolios or investments that we do, it's not that, let's say we park in 50 lakhs and we forget about it. It's more about the scalability that we do, or let's say the future add-ups that we do in the portfolio. So this is some initiative that we're doing to, let's say, to filter out, let's say, what is the true potential of an investor. And that's something that we call as million dollar milestone portfolio. So let's say, for example, as you know, as per the SEBI mandate, in a PMS, the minimum investment is 50 lakhs. So that is the first assumption that we have taken. So let's say, for example, in the first, let's say, case that you see is existing corpus 50 lakhs. And here I've taken a return assumption of 12%. So let's say, for example, let's say if you compound the 50 lakhs at 12% growth rate, your portfolio will reach your 1 crore milestone at 6 years. Same thing, it will, let's say, for example, it will take another 6 years more to reach 2 crores. Another, let's say, for example, 6 years more to let's say 4 crores and then 8.5 crores, that would be a $1 million portfolio. So there's something called the rule of 72. Let's say, for example, if your FD is giving you 7% growth rate, 7 divided by 72, it's 10. It takes 10 years to double your money. So let's say 12% would be 12 divided by 72 is 6. So it takes 6 years to double or compound your money. That's what is, let's say, visible on the first slide. So why not? It's like we do some additional, let's say, bump in your, let's say, portfolio doubling and make it more faster. Let's say, for example, you start a 50 lakhs portfolio, rather than just let it sit and compound over a period of few years. We do a monthly addition of, let's say, SIP also. So I've taken an assumption that, okay, going forward, let's say next 10 years, we'll do some additional contribution. In that case, in first scenario where we are able to reach the goal of 1 crore in 6 years, we can do it in 2.6 years if you do a 1 lakh SIP in your 50 lakhs portfolio. Same 2 crores goal can be reached in, let's say, same half of the, let's say, initial, let's say, case that we have seen in 6 years, 4 crore in 10 years, and straight 8.5 crores in 15 years, and so on. So same thing, let's say, for example, why not we step it up further? Let's say every year we tend to get certain hikes or, let's say, bonuses from our company, right? Let's say rather than spending it or, let's say, using it only for our expenses, if we use it for our savings meaningfully, let's say we assume 1 lakh SIP is what you're doing. Every year you keep on doing a 20% step up on your monthly SIP. So same thing, let's say what you're able to reach your $1 million milestone at 15 years, you can reach it at 11 years. Let's say, for example, okay, SIP is something that is not in your flexibility. If you're a freelancer, if you're a professional, if you're a doctor, and let's say your monthly cash flows are not, let's say, flexible or stable, and you prefer doing a quarterly or a half yearly scale up. Let's say, for example, on a yearly basis, you may bare minimum do a 20% top up. Let's say it can be a 10% top up every 6 months, or let's say 20% top up every yearly. Same thing, you can reach your 8.5 crores $1 million milestone portfolio at 9.4 years and so on. So just one thing that, let's say, we try to see, okay, what if we combine SIP, step up SIP, and let's say annual top ups also. In that case, let's say where it took us 24 years to compound your 50 lakhs portfolio without any addition to reach your 8.5 crores $1 million portfolio milestone, it takes only 7 years to reach that $1 million milestone. So obviously everyone's personal finance is going to be very dynamic, and it's not going to be saying that let's say we can do more of this, let's say 1 lakh SIP amount, or we can start with 50,000 of SIP amount also. So we would help you curate your financial goal, or let's say a milestone that we will work together for and will scale up for. Because when a milestone or a financial goal is assigned towards your investments, we are more serious about it, and then we focus on reaching that milestone as quickly as possible. So that is what with the $1 million portfolio exercise that we do. And this is one of the important concept about core and satellite portfolio. So let's say, for example, core portfolio would be something, let's say, it can be a purely conservative portfolio that gives you stability of your, let's say, investments, or it can be a high growth, aggressive portfolio that gives you the alpha that you need in your investment journey. And there needs to be a satellite portfolio that complements your core strategy. So in short, let's say, for example, if as Nakul discussed about solitaire portfolio, as investment philosophy or a decision, we don't have a banking or NBFC exposure in that solitaire portfolio. But there would be at times in the market where banking sector is more attractive. So then we can add that allocation via banking mutual fund also. Or let's say we can have a product pairing of solitaire and spear that complements each of the strategies. So hence, let's say even if you have one PMS or let's say one mutual fund, we need to focus on the other satellites or let's say other core areas based on, let's say, themes or conviction that gives you good opportunity. You need to start scaling up that too. So hence the core and satellite portfolio would be the same concept. So let's say, for example, if you are looking for a portfolio like a true blue, you need to have a satellite portfolio where you have other multi-asset allocation also, rather than just having pure equity allocation. So that's the concept with the core and satellite portfolio. So next would be product pairing. So each of our portfolios are, let's say, actually curated in such a case that it's going to be, let's say, complementing your strategies. Because one thing is no single strategy works in every market condition. So first, different strategies would perform at different times. So let's say if one strategy lacks, the other would complement and lead and provide you overall balance in your entire net worth asset allocation. Second, it creates an optimized risk return balance by combining, let's say, growth focus or let's say value growth strategy with a high growth or high risky strategy. You ensure that your portfolio is working smartly and not just aggressively. So third, it would also provide you a cushion against volatility. Let's say market swings are inevitable, and but diversification across strategies can make you, let's say, your investment journey more easier to handle. Let's say if you have a solitaire and spear as a product mix, that's a great win-win situation for you because you have decent equity allocation that you need in your Indian, let's say, markets, and also the multi-asset allocation that you need. And also whenever there's an opportunity in global markets, we do have some exposure in spear and EO2 regarding that. So in short, product pairing would give you profit, let's say your portfolio with stability, balance, and the purpose that you need in your investment journey. So yeah, so this would be just a few snapshot of the performance since inception for all the portfolios, Solitaire, True Blue, Vritti, and multi-assets on the upcoming slides. So I would say all the portfolios have done good in the past, but I would say this won't be the right metric to gauge. Would this portfolio would be a right fit for me? Obviously, there are a lot of things that goes behind your risk positioning, your existing portfolio. Will this product complement that, and so on? And hence, I wouldn't say this performance metric should be only the deciding factor because obviously last 5 years market has also been very kind. And let's say if you ask me what would be the return expectation that you can set for a portfolio like Solitaire and multi-asset portfolio like Spear over a next 5 years time horizon, it's going to be 12 to 15%, let's say, assumption that you can set aside. Because one thing would be is, let's say, it won't be as linear like a fixed deposit that every year you end up getting 12 to 15% on a yearly basis. But let's say, for example, let's say, we don't, let's say, perform this 1 year and let's say markets are going to be volatile. We'll try to see and we'll try to catch up on the next 2 to 3 years time horizon and so on. But end of the 5 years time horizon, you can expect or let's say see a compounded growth rate of 12 to 15% growth in the portfolios. But one thing is, let's say I said about 12 to 15% growth rate is what we are setting as an expectation for next 5 years. You can boost it out and let's say double your compounding in your portfolio, as I spoke in the $1 million portfolio, by adding in inflows whenever there's an opportunity in the market. And we as an advisor make sure that we'll reach out to you to participate in such an opportunities. So that would be from our end regarding our portfolios. So this is the just a quick snapshot on the key terms and conditions of all the portfolios. Like we discussed about Solitaire, multi-cap portfolio, True Blue, Pure Blue Chip, Vritti, small and mid-cap, and Spear, the dynamic multi-asset strategies. So for Solitaire and Vritti, we do have exit load in this portfolios because being a pure equity portfolio and pure aggressive portfolios, first year there's an exit load of 3%, second year 2%, and third year there's 1%. Even if True Blue and Spear doesn't have an exit load, we motivate our investors to be at least or let's say participate with a time horizon of 3 to 5 years plus time horizon. So in Solitaire and Spear, the management fees is fixed at 1.5% on your assets under management on a yearly basis, and it's going to be charged on a quarterly levels. And let's say at True Blue level, we do have two options. As I spoke about, one thing would be is 1% fixed fee option. Second option that investor can choose would be 0% fixed fee and performance fees of 20% above a hurdle rate of 6% with no catch up. Similarly, for Vritti, there's a 1.5% fixed management fee, plus additionally, there is a layer of performance fee of 15% above a hurdle rate of 8%. That would be, let's say, the management fees for this portfolios. And for all the portfolios, the fund manager is Mr. Shyam, Sekhar. But for each portfolio, there is going to be an investment committee team where 3 fund managers work together. And there's a 15 to 20 member research team too, who will be pumping in ideas into this investment committee team where they monetize this and let's say participate and let's say add in your portfolio. Thank you all for joining us.